Welcome to CPE Voices, our series through which we present insightful discussions among industry thought leaders, moderated by our editorial team. During this outlook for 2026, we'll be addressing key questions that may be top of mind as we head toward the new year. I'm Suzanne Silverman, Editorial Director of Commercial Property Executive, and I'm here today with 5 leading industry experts. Jeff DeBoer, President and CEO of the Real Estate Roundtable, Merrie Frankel, President of Minerva Realty Consultants, Richard Kleinman, America's Co-CIO and Head of Research and Strategy at LaSalle Investment Management, Ryan Krauch, Senior Managing Director at Affinius Capital, and Thomas Whitesell, Head of the Debt Investment Group at Kennedy Wilson. We're recording this session and it'll be available for later viewing. In addition, we're going to leave some time at the end to answer your questions, but please feel free to submit them at any time during the webinar. And thank you to those of you who submitted some in advance. We'll try to get to as many as we can. First, though, Rich, could you please set the stage for our discussion?
Sure, happy to. And thank you for having me. I thought I'd start by just sharing a couple of charts that frame the economy and then the capital markets and then the real estate fundamentals. So we look to turn the page from 2025 into 2026. In terms of economic growth, what we're seeing is kind of slow and steady growth. Nothing that spectacular, nothing that's going to really drive a lot of real estate demand, but also a recession isn't in that base case. We're kind of dealing with a lot of tailwinds from things like AI investment and fiscal stimulus, along with some headwinds related to policy uncertainty. Job growth, well, we haven't had any data for a while, so, I don't have that much to talk about there, but it does seem like job growth was slowing. So we're seeing a little bit of a disconnect between the decent economic growth we've seen and some slowing job growth. We're going to start to get some new data on that in the next week or so. So we're eagerly waiting to see kind of how things have been for the last couple of months as the government shutdown now ended, and now we're allowed to see some more updated data. During the shutdown, though, we did get some CPI data. CPI has remained stubbornly high, I'd say. Nothing like where we were a few years ago, but still not to the Fed's target of 2%, kind of closer to 3% on average. That's not great, but the Fed seems to be behaving a little bit more like their target is 3% than 2%, because we have had 2 rate cuts in recent weeks. And so you can see in that chart on the bottom right, the Fed rate cuts coming down. The 10-year, though, which I tend to view as a little bit more meaningful to kind of real estate investment trends, is real estate is a long-dated asset class, especially for core investors. That's been pretty steady, up a little bit, down a little bit, but generally in that low 4% range. And as we look at real estate pricing relative to that, we kind of think that's about the fair value. So, if rates start to fall, we think that would be a positive for real estate value. If rates go up more, it would be a negative, but kind of remaining in that low 4% range is supporting activity. And just the stability seems to be generating more transaction volume. So if we go to the next page on the capital markets, you can see a lot of these charts have a lot of big waves in them. We've been through a rocky couple of years, that's for sure. Transaction volume is started to pick up again in the back half of 2025. We thought it would pick up in 2025. Liberation Day uncertainty kind of disrupted that for a while, but really does feel like some momentum is building in the transaction market. The Green Street Property Price Index shown here on the next chart, kind of a really good indicator, I think, of market pricing. So they're really adjusting this month to month based on what they're seeing in the market. 22% decline. We dealt with that, driven by higher interest rates. Started to see stability in the first half of 24, then an uptick in the back half of 24, kind of more stability in the first part of this year. And we're starting to see some upward momentum again, which really does seem to reflect what we're seeing in the market. Definitely past the bottom and starting to see a little bit of upward lift. As we think about appraisal metrics, which are kind of driving the values that investors might see on their open-end funds or the separate account portfolios, those kind of lag the market a little bit, but we have seen stability in those key appraisal metrics like discount rate and terminal cap rate. So another thing that's kind of helping give investors some confidence that we've reached a bottom on pricing and are starting to see some signs that upward momentum is building. The stability really does mean that what's differentiating property performance is the fundamentals rather than some big macro capital market move. And then in terms of the Odyssey, the NCREIF Odyssey open-end diversified core index returns, definitely a period of write-downs as those discount rates were going up and as market values were going down. But we've reached a point where over the last 5 quarters, returns have been positive. Not a lot of appreciation in there, Some in some quarters, a little bit less in others, but generally with income getting to those positive returns. Then if we turn to the fundamentals on the next page, looking across a few of the major sectors here and a few of the secondary sectors as well, definitely a mix. Generally, in many sectors, we're seeing the digestion of elevated new supply and outlook of much less new supply, a mix in terms of demand, but expecting kind of moderate demand going forward. Life sciences has really been hammered by a lot of new supply, along with some real headwinds in near-term demand. Kind of expect that to correct over the long term, though. Office, I don't need to get into the challenges that sector has faced. Self-storage kind of hurt a little bit by the lack of movement in terms of people buying and selling homes, but not really in distress either. Industrial had a worse year than what we thought in terms of demand, so vacancy did tick up, but just reaching that long-term average. Apartments, on the other hand, had a much better year than expected in terms of solid demand in the first half of the year and is back below that long-term average. Medical office, kind of slow and steady and boring. Not a lot to say there, which is what it promises and what it tends to deliver. Retail, definitely a mix across different subsectors, but open air, especially grocery anchored, is looking quite healthy. So that's hopefully a nice rundown of what we're seeing across the various sectors, and I'm sure we'll get into some of the more dynamics underlying these and others throughout the conversation. So Suzanne, I'll turn it back to you and the panel.
All right. Well, thank you so much, Rich. Now let's get into some discussion and some perspective on what's to come. Let's start with a broader question. And Merrie, maybe you could start us off. How do you expect commercial real estate to perform next year, and what are the main issues to watch?
Thank you. Can you hear me okay?
Yes.
Good. My sound was acting funny. I have I have a cautious outlook, but expect that commercial real estate development and investment will perform somewhat better in 2026 than it has this year. It depends if you look at the glasses being half empty or half full. People are navigating defaults, inflation, and tariffs through number one, lower interest rates, and number two, dry powder to invest. And I think we're going to be going through some of these points I mentioned throughout the rest of the seminar.
Yeah, if I could add in a couple of things,
Yeah.
I agree with Merrie on most of it. I think the thing is like we're just going to have a mixed bag again, like this year. I think next year is going to be pretty much mixed bag. You're going to have your Class A haves and have-nots, right? So like I'm in New York City right now. If you're in the office space, I'm actually right by the new JP Morgan building. So everything around here is on fire. It's very difficult to get office space. The rents are the best in the nation. So you have real good market here, but other parts or other streets aren't as strong. So again, I think it's going to be a have and have nots. Same thing. I office in LA mostly, and in LA it's the same thing. Downtown you have about a 30% vacancy in downtown, and values are just at the very bottom. But then you look at Century City, and it's like about a 98% occupancy with record rents. So again, I think the office sector is going to continue to see that. I think across I think you see that in all markets overall. Multifamily is obviously the strongest product in all markets across the way, and probably the safest thing for people to invest in right now.
Anybody else have anything to add?
Actually, I heard an interesting comment at the ULI conference in San Francisco 2 weeks ago. One person said, there have only been 3 major downturns in CRE over the past 50 years, which got my attention. The first 2 were due to supply and leverage, and this cycle was manifested by interest rates.
Interesting thought. Anybody have any comments on that before we
Well,
roll into policy?
if I could, I think that everyone's identifying the bifurcated markets that are out there, but it's really bifurcated markets within markets and products within markets. And so obviously Class A premier office is doing much better than B and C office regardless, but and then within some markets much better. And it's the same on all of those things. I was really fascinated by Richard's charts there showing long-term vacancy rates for all product types, and kind of interesting that almost every product type except for life sciences and office, I guess, on your charts were vacancy rates below the long-term average, which again bodes well, I think, for assuming the economy and businesses expand for people. So
let's talk a little bit about policy, and Jeff, I'll keep you on the mic here.
Yeah.
How much of an impact have recent federal level initiatives and legislation had on CRE?
Well, look, I mean, people obviously local decisions, the city council, zoning issues, all of these things are things that people in the real estate business really feel and experience on a real-time basis. And frequently, I think the federal policy impact might be forgotten, partly because it's been so good over the last 20 or 30 years. And but having said that, I think if you just started, well, if you want to include monetary policy, as was just said, obviously interest rates being artificially low for a historically long period of time and then going up very rapidly in a historically dramatic fashion, whiplash, investors and owners. But separate from monetary policy, fiscal stuff, the 2017 tax bill had a significant amount of real estate provisions, all positive, and some of the provisions that weren't in the bill that were designed to be positive, are good that they weren't in there. For example, they wanted to give all buildings expensing. Now, just imagine had building a building or buying a building from 2017 on been expensed in a time period of interest rates. Remember, the 10-year was about a half a point in 2020. There would have been a lot of product on the market that would have exacerbated what then came through the pandemic in terms of back to the workplace and choosing other. So, sometimes it's provisions that aren't in, sometimes it's provisions that are in, but 1031 continues on. Real estate's the only asset class that you can trade in a tax deferred delayed manner. No more art, no more limited partnership, none of that stuff, just real estate. Business deductibility of business interest expense. No industry other than real estate and utilities continue. So that's very positive. In this last bill that was done, the big beautiful bill, set aside its impact on the deficit. We'll see about that. We'll see about the impact on hospitals and so forth. But for real estate and housing, for example, the low-income housing tax credit boosted by roughly 12%, opportunity zones made permanent and beefed up and modified and improved. Again, no 1031 changes. Carried interest continues on. Capital gain continues on. The partnership and pass-through tax regime continues on, all of which were on the targeted chopping block, if you will, and maintained. There was a very deleterious, potentially very damaging proposal on foreign capital investment coming into the United States in a retaliatory manner, which was shelved at the last minute. And on that note, by the way, just a couple of weeks ago, we successfully had a final regulation at Treasury. It was a final reg. It was the law dealing with investments through domestically controlled REITs, which is a big thing for foreign, particularly sovereign funds and others, and had that completely repealed to, again, bring in more capital. And as was said, it's a very capital intensive business. And so we need capital. So all of that, yeah, there's a big impact on real estate from Washington. Sometimes it's not reflected. I guess I would just wrap up by saying, looking ahead, we've got the terrorism risk insurance program, which was put in place after 9/11. It is coming up for expiration at the end of 2026. And so we have to extend that. And people will say, well, why do you need that? Well, because you have to have all risk covered on or you won't get financing on certain aspects. So we have to deal with that. There's a big housing bill moving through that has passed the Senate now, 77-20. People say there's no bipartisanship. This bill passed the banking committee, was sponsored by Tim Scott, a Republican from South Carolina, and Elizabeth Warren, go figure. And it passed the Senate with 77 votes. It's going to be in the House. And it will help streamline permitting at the local level. It will incentivize and streamline regulations relating to modular and manufactured housing, which a lot of people kind of forget about. It's got some rules in there to help conversions and some other things. So there's a big housing bill coming up. And then finally, what we're focused on in a big way is energy. And how will the grid going forward be accessible to meet the demands. And people talk about data centers, but it's all businesses are going to be pulling down more energy. Where's it going to come from? How can you get on it? And these are very important things for investors and development going forward. But those were great slides, I think, that give a snapshot of where, and uncertainty and so forth. And then the final thing, I guess I would say, is with the government back open, there's been no data on, as was said, on, inflation and pricing and so forth. So we're kind of a little bit flying blind going into the Fed action coming up. And a lot of people would have suggested rate cuts, another 2 rate cuts. I don't know now, and because we don't really know what the data is. It's closer to 3% on inflation or closer to 2.5%. And all of this will drive Jay Powell and the Fed. So pay attention. If you're not paying attention to Washington, I don't think you're managing your risk, but pay attention. Thanks.
Hey, maybe I could ask a couple questions and get your take, Jeff, on a couple different topics. One is with regard to this is the tariffs and how that's having an impact. So we do mostly construction lending on multifamily projects, and we've seen the tariffs create a lot of uncertainty. And so we've seen a lot of the LP investors, which I think is the biggest issue, which maybe we'll talk about later on the investment, but that's the hardest part of the capital stack to get right now is the equity. And a lot of people are just sitting on the sidelines because the tariff situation being on again, off again. On the construction side, what we've done or looked at and talked to a lot of our developers, they've seen basically with a lot of the tariff that are still in place, they've done their best estimates. And basically as we've gone through it this year, after Liberation Day, we've kind of determined it's like a 3 to 5% increase in the hard cost, but there's less deals. So the soft cost, the labor side has gone down about 3 to 5%. So on the construction cost overall, we're seeing a pretty much flat on that side of it. But I guess the uncertainty is creating a big issue for at least the construction side of the business. I'd like to hear your take on the tariffs overall and how that.
Well, I think you've answered your own question. I think there's a great deal of uncertainty, particularly on, obviously construction costs, steel, glass, wall curtain, and all this stuff is potentially impacted. But I guess the issue and the question that seems to me is, if the tariffs go away, will those costs come down? And I mean, I'm not in the business. I'm watching the business and talking to people in the business, but I don't know anybody who lowers costs after they've gotten up. It rarely happens. And so, a lot of this stuff is being priced in already on materials. On labor, I'm kind of surprised at what you said, but I mean, I'm not disputing it. I'm just kind of surprised that labor costs are going down given the immigration situation and construction workers in general. It's kind of in a shortage, I would say. I don't see much action on tariffs in the immediate term, despite what you said there. And I don't want to get too far out on my skis, but I don't see them doing that. Although affordability is a big, big problem and getting more and more airtime, and perhaps it flows into a second year of Trump's term here on an affordability agenda. Immigration, on the other hand, I think that the future might be more bright than it's been in quite some time for immigration action. And I say that only because Republicans have always said we're not going to deal on immigration until the border is sealed. Well, arguably the border is sealed and secure, I guess, if you want to use those terms. And so now there's an ability to talk about more long-term immigration reform. One thing back on construction that we've been advocating is a special visa program. We have one for ag workers. We have one for, smart people, I guess I would say. What about construction worker on a visa program that would bring in more workers? But I don't know how to respond other than it is an uncertainty, and there's been a lot of it lately. But I don't think it's necessarily going away.
Do you think if the agencies there's some talk about the agencies becoming going back to being private?
Yeah.
Do you think that what do you think that affects on interest rates and the CRE overall for residential financing?
Wow, this is like I was going to say this is like therapy for me, but now it's like I'm back in college being peppered by my professor or something. That is a real difficult one. First of all, the desire to take Fannie and Freddie, out of conservatorship is very strong within the administration. And I believe it's very strong there because of the ability to monetize an asset, not necessarily looking at its market, but they view it as an asset that could be monetized. On the Hill, there's always been a kind of a concept of let's reform Fannie and Freddie to more clearly accomplish its mission. But then it breaks down on what is its mission. And so it's always been more smoke than fire on doing something on Fannie to get them out of conservatorship. That I guess right now I put my thumb on the scale that maybe something does happen this time and they do go out to market with Fannie and Freddie. Boy, if it's not done carefully, the way that the implicit guarantee currently works, it probably gives 25 basis points or something like that on versus non-conforming loans. If they don't deal with that carefully, it could very significantly mess up the residential financing world. And if that gets messed up, then the entire financing world gets a little bit confused and convoluted. So I think it's really a important topic, and how it's dealt with will dramatically affect liquidity and pricing and investment. I can't tell you what's going to happen other than there is definitely a stronger effort by the administration as opposed to a senator or a congressman pushing it, and that creates an entirely different dynamic on what the outcome might be.
May I just quickly add something? The August 2025 executive order from the Labor Secretary to consider including private assets in defined contribution plans. Although the timeline is, uncertain at the moment, I think the potential scale is significant for people putting private real estate assets in their defined contribution plans. And you could have more development, more investment in CRE. And on the other hand, I wonder, we all know something about real estate, but, does everybody who may be thinking about putting these in their retirement plans, know enough about real estate to vet the investments? But that's a whole nother seminar. But I wanted to mention that change.
Well, it's something that we've always thought about here in general terms about access to capital. And we want, our mantra has always been here, we want an appropriate a level of credit and capital available. We don't want to surf it level. And, too much capital coming into to any asset, that's what people talk about now in data centers, for example. Is there a bubble being created there and so forth? So, you got to watch out for what you wish for. And sometimes too much capital is too much, but Richard or others may have a comment more informed than mine on that.
Well, I think you're right. Too much capital can be a danger. I think, with respect to defined contribution capital moving into private real estate, there's certainly structures that can do it responsibly and safely and not stress the real estate market too much. Or, it could go the other way where, you end up in a, kind of bubble situation. But as with everything, it seems like the devil's going to be in the details and how that all gets worked out. So we'll see.
I always know a market is out of balance when my brother-in-law comes to me and says he's going to invest in a particular industry. And I go, okay, but I'm not.
Well, let's stay on the topic of investment for a bit here. And Ryan, I'd love to get your input on your expectation for the pace and the volume of investment next year and what's going to happen with all the dry powder out there.
Yeah, I mean, I think it's hard to look in our business, especially right now, in terms of 1-year chunks. We tend to think of it more in a 3 to 5 year lens, but I do think there's some optimism for next year. I saw a recent survey of real estate professionals, and I think 83% or something believe that revenues broadly would be up and investment activity would be up. So that's a very positive sign. However, a much smaller percentage of that thought that they would be willing to spend more on their business also. So the psychological optimism may may exceed the practical. So we'll see how that plays out. But I think with a 3 to 5 year lens, I'm certainly very optimistic. I think there's a lot of decent signs out there. I think as Merrie mentioned earlier, this has predominantly been interest rate driven in terms of where the issues are. This has not been a real estate supply issue or over leveraged issue with certain exceptions. So the fundamentals are actually, relatively decent. And I think the industry's been a lot more disciplined in this cycle than others. So broadly pretty optimistic. All that being said, as has been mentioned, what is crazy about the last few years is every metric you can think of that we normally use to predict macroeconomic trends or real estate trends have been either dead wrong or so confused and muddled that it's impossible to sort of, piece out of there what's going to happen next. And so, as we all know, uncertainty is not great for investors. And there's been a lot of, let's say, events out there that are causing uncertainty, but also just this general concept that, well, I guess in the last 2 months, we literally have not had a lot of data, but even the data we get is so muddled and so confusing and so contradictory in many ways that it's just hard to feel a lot of confidence. But there is optimism out there by real estate professionals. I spend a lot of time with our investors. I think there's certainly a lot more interest and desire to deploy capital. The dry powder out there it's been trending in the right direction. I mean, it peaked probably 3, maybe 4 years ago, and it's been on a declining trend since. So I think that's actually healthy. Now, some of that is also a little bit shadow driven by the fact that secondaries have been, quite substantial in the last few years. So investments have been less made on a direct basis and more on a secondary basis. I think we just saw Stepstone raise something like $3.5 billion for their secondary fund, which is up from like $1 billion in their previous fund. So massive, let's say, shadow capital out there, and where that goes is anybody's guess. So certainly signs of optimism. We'll see if it comes next year or the next couple of years.
Yeah. Another thing I'd point to on that investor side is the denominator effects. Like, last several days notwithstanding, the stock market has been on an incredible run. As I showed, real estate values kind of trended lower for a while and haven't moved that much higher, especially on the appraised value metrics. So, you're seeing an increasing number of institutions that are below their target real estate allocation. Now, there's more competing for that allocation in a way, whether it's data centers or infrastructure, things like that. But I think more and more investors are positioned to allocate new capital to real estate, and they just need confidence in the market to start doing that. I think several are holding back, and maybe it's because of real estate, but it also might be that they don't believe the stock market values and don't want to end up over allocated if that starts to correct. So, there's some of those broader capital market dynamics that are kind of setting the stage for, I think, hopefully a positive dynamic, but still that uncertainty that Ryan was talking about is there.
It's a great point. I think just to add to that, I've been calling it the numerator effect, right? Like, I agree there is no denominator effect, at least relative to the stock market. Bond market a little bit different. But one of the challenges, though, is we are notoriously bad as an industry about resetting our values, right? And other markets are way better at that and have moved through this cycle faster as a result. So you just haven't seen on a massive scale capital flowing into real estate like it has in other areas because you just can't get the marks, you can't get liquidity. So you've seen that money flow into corporate credit, you've seen it flow into private equity, and they've been well rewarded for that. I suspect that we're starting to see signs of breakage in those sectors, and so I think you'll see some of that capital start to free up. At the same time, we are finally getting some marks right, and I think Odyssey valuations, although not correct, are getting closer to where they should be. So if all those things kind of converge at the same time, that should bode well for us.
Of course,
Merrie,
I was just
sorry.
going to say strength in the stock market or strength in businesses in general is obviously very good for real estate because that would expand their demand if you're in the office sector, or expand their footprint, what they're even taking or using. So, overall positive capital going into the rest of the economy is actually also good for real estate, and eventually that capital will come into real estate anyway. But it's not as if we're competing against them or fighting for that capital. Them doing better actually helps real estate. It would be my perspective on this, and sometimes it's lost on some industry participants, I think.
Mm-hmm.
So I liked your report there, Ryan.
Thank you. Although we could probably spend another 10 minutes on this topic because I think you might be right in the long term. I think in the short term, we're seeing the opposite, right? Like, where's the money going? It's going to data centers. And that's been I mean, without AI right now, the economy is
Mhm.
probably flat GDP wise, right? I mean, AI is just, and its subsequent effects is so large. That's really been driving the economy, but you don't see AI pop up, at least short term, in office, right? And those kinds of things. You're going to see it first in just energy consumption and where do you house the data, and that's what's happening right now.
Yeah,
Um,
but but the AI, those companies do take a lot of space, the AI
yeah,
companies themselves, and
Mhm.
to deliver the product, the AI product, whatever that means. And I'm the last person to be talking about artificial intelligence. I mean, well, maybe I am talking about it, but I think that, yeah, it's in the ether, but they also do take demands. And some areas, Boston, suburban Boston, and some other areas are being driven a lot by AI companies. It's kind of interesting to look at that way. But
and you saw in the dot-com bust, right? I mean, I remember underwriting office in Silicon Valley, right? After the dot-com burst. And when we did the math, we could not fathom office being filled again for like a decade. I mean, the math just made no sense. And within 3 years, it was not only full, but it was undersupplied. So yes, there's no question that I think is a knock-on effect. I just think there's a short like period where you're seeing a skewing of capital flows and demand into certain areas. And I think, Richard touched on it earlier, like you look at office in New York, it's great in about, two different streets, and the rest of it is junk. And so you still have a long ways to go. But San Francisco, I was just there for ULI. It sounds like others were too. You saw there's actually some good progress being made there. You're seeing revitalization in certain areas. You're seeing some policy changes. So yes, I think it's there. It's a lot faster to destroy office demand and other ancillary demands, and it takes a lot longer to rebuild them.
I'd like to remind the audience we're getting close to Q&A time, so please do put your questions in the Q&A section at the bottom of your screen if you do have them. We would like to get to as many as we can, and I'm sure you've got a lot of them. Let's talk a little bit about debt too, as I'm watching the time here. Um, Tom, give us the scenario. How's debt availability going to affect the market in the coming year? And do you see it picking up yet?
Yeah, absolutely. I think debt is, I always say this to everybody, it's a good time to be a borrower. The 2005, I mean 2025, 2005, 2025 this year, starting at about the second week in January, we started seeing so many different lenders come back into the market. Obviously, the private lending market has been, with the debt funds and all that, have been fairly active, but they've gotten much more aggressive. But what's happened really this year is that the banks have decided to get very aggressive, and we're seeing them actually in construction lending and getting aggressive in that space sometimes. But also what they're doing is they're providing the debt to the debt funds, and it's been a really good business for them as well. So I do see, actually, if you go back to 23 and 24, they were sitting on the sidelines. All the banks were sitting on, not all, but most of the banks were sitting on the sidelines, not really going after a lot of deals. And the private sector came in and took over that space and still has. But now we're seeing the banks back leverage a lot of these debt funds and also provide some direct lending as well. And so I expect that to continue in 2026. I do think that they sat on the sidelines for probably longer than they wanted to, but now they're active. They need to grow. A lot of these regional banks, have been kind of sitting somewhat dormant, and they need to start deploying some capital. They're also going to have to, I do believe in 2026, I do think that some of these banks and other lenders, I mean, all lenders that were active in the early 2000s got caught a little bit with some of these office and some life science deals, and they're going to have to just unload them. And that will be some good opportunities for some investors out there.
If I could add something, Suzanne,
Please.
what's on the debt side, which I love debt, not personal debt, but I love debt structuring. On the unsecured REIT unsecured debt issuance, which the market I've spent a lot of time in, it's been booming this year. As of the end of the third quarter, you had about 39 billion issued in REIT unsecured bonds. And all of last year, you had about 48 billion issued. And people think that, we'll get up to last year's or even more. 48, 50 billion in unsecured REIT issuance. The CMBS issuance also has been going like gangbusters this year. As the end of the third quarter, it was 92 billion, with projections of over 120 billion by year end, making 2025 the most active year since 2007. And a lot of this CMBS issuance has been driven by SASB, single asset, single borrower deals. That's been about 68 billion of the 92 billion, so about 2/3. And think about it, you've had 92 billion year to date. They're saying projecting about 120 billion of CMBS issuance by year end. Last year, 2024, you had about 106 billion issued. So it's clearly going to be more. And now your average issuance of CMBS is typically about 75 billion, excluding 2005 to 7, that were banner years when you had over 200 billion being issued for those 3 years. And then, of course, the years after the GFC, when, the market was non-existent. So it's been a pretty healthy, even though interest rates are higher than they were a few years back, it's been a pretty healthy market for both, bond issuance and CMBS issuance.
And how much distress do you expect to see in the market next year?
Interesting. I think there will be some. In fact, statistics show that there is more on the CMBS side, there's more distressed the last quarter and this year. But what's interesting, I was reading, is some of that distressed is being paid off, worked out, and it's coming into the special servicers, and they seem to be working it out a little faster than I remember seeing in past years. But as far as how much distress, despite the extend and pretend, or the proverbial kicking the can down the road that we also talk about, I think there's going to be some movement for the banks to start to write off some bad loans. And I think we were talking about that before. I think, I've been saying this probably for a while, and maybe it will come true. But I think at some point the regulators are going to say, look, you got to write this off already. So more and more I'm hearing from my lawyer friends, my real estate friends, accountant friends, people in the business, that the banks will probably going to start writing off some of these bad loans that we've been seeing for a number of years. Also, number two, you have that debt maturity wall that we've been hearing about for so many years. And right now it's at about 2 trillion for the next 3 years. So I think people with loans are going to have to start, refinancing, figuring it out, getting it out of special servicing, giving back the keys. I think something's going to move this penny forward. So you're going to see some distress. I think you're going to see it move through the funnel, or whatever analogy you want to use. But I think there's going to be some, because interest rates may be going down more, I think there's some light at the end of the tunnel to move this through.
Any other thoughts on that?
Well, it's funny what Merrie said, that we've said this over and over and over in 23, literally in 2023, in November, December, I said to our team, get ready. In January, February, they're going to, the regulator's going to come in and basically tell these banks they're going to have to sell it. So we got to be able to go on there and pounce on some of these. These maybe be some good buys. Then last year I said the exact same thing. Eventually it's going to happen. I'm going to be right, and Marie's going to be right too. This year I do think that they're at a certain point, it's not going to be just a avalanche of deals coming out there, but banks are going to have to start getting rid of some of these that are just sitting out there for too long, and borrowers are just like, hey, I've carried it for you for, I'm basically carrying it for you at this time. I'm turning the keys back to you. So I do think that's going to be a place for some opportunities out there. I mean, the market is extremely efficient. So these banks or private lenders or whoever have it that are going to go sell these assets, it's not, they aren't going to take that big of a hit. They're going to take a hit. There's no question, but there's going to be a number of bidders for that. So I think they won't get hurt as bad as we think.
Yeah, and part of the problem in the last couple of years, obviously, was value. No one knew what value was. There was no discovery of value. That is slowly changing, and transaction volume is increasing, as Richard's slides showed. And so, will the losses be as large as people thought they were going to be a few years ago? Probably not. Are banks going to continue to want to modify these loans rather than, foreclose or what have you? Probably. And but there will be a lot of distress and a lot of opportunity. There are going to be a lot of obsolete buildings, particularly in the office sector, but in others as well, that will probably have to be demolished, and a new use put on that land, which of course is the way that real estate has always worked. That when it doesn't work anymore, you rip it down and you build something more, and there's going to be an awful lot of that, I think. And that's going to be good, and it will attract new investors, and will meet the new demand, whatever the new users, people, and businesses want in the future. So I think it's a great opportunity for a lot of people, but distress for some current owners, that's for sure.
And think about in New York, all the office to apartment conversions going on under the 467M program. And everywhere there's a number of them going on. One actually across from my apartment building, and I think although some people I know who are doing them are thrilled, and then I've talked to friends of mine who do these conversions and said, "Did you bid on that?" And they said we couldn't pencil it out. It's all in the eye of the beholder whether it pencils out.
Yeah, and not only and in the hands of some local officials on terms of what property tax abatements or incentives they might provide if you convert, and all of that in each market is differently. I think New York, something like there's 400 and some million square feet, I believe, of office up there, and like 15% is going to be converted or something like that, which is kind of a big number, I guess. And nationwide, a lot of it. Here in Washington, D.C., there's a significant amount of B and C buildings which need to be converted, repurposed, or demolished because they're a drain on the owner, they're a drain on the city, and they're just not viable anymore for the new world. And that'll be troubling for some people.
And in New York, they have to start the project by June of 2031, and you have to complete the projects by December of 2039. So there's a nice window to complete all of these conversions and get the tax abatements and whatever.
Yeah, a few things I observe on this dynamic. One is that in almost every case, there are losses. The equity's gone, the debt is losing money. So, this is not a solution to distress. It might help the office market long term.
Yeah.
The other thing is, I think a lot of focus goes to like the New York office buildings getting converted, but what we see a lot of is the suburban office buildings, which there are more of, and those aren't conversions, those are just demolitions, and there's just an increasing amount of them. The suburban town I live in, office buildings are getting torn down and single family homes are getting built. It's not as complicated as converting a downtown New York office building to apartments, that's for sure.
And by the way, not to dominate on this point, but from a national policy perspective, those demolition costs are going to be added to the basis of the land, which is an expensive proposition. And we've been talking about how you might want to encourage those demolition costs to either be added to the basis of the new structure as opposed to the land, or be expensed immediately in some way to encourage this process of obsolete being got removed and new productive assets being created. And there is some national public policy that could be helpful here if we could get it done.
That's interesting. We are coming up to Q&A time. Rich, I'd like to loop back around a little bit to more about the fundamentals, and we've just been talking about office buildings needed to be converted or torn down and so forth. Are there any growth industries that are likely to fill some of this office space, maybe not the obsolete space, but just growth of particular office user types in general.
I think we touched on this a bit earlier, that the biggest growth industry out there right now is AI. Obviously
Right.
driving a huge amount
Yes.
of data center demand, San Francisco office space. I see the leasing reports on the buildings that we own there, and the number of prospects coming through is way, way more active than it used to be. So, that's definitely a needle mover. I'm sure others are seeing other things move in their portfolios and interest coming in. But I'll take the easy one, which is AI.
Any other ones besides AI? Or is that just where everything is now? I mean, it is, but
Well, obviously, housing is, I guess you want to go where there is strong demand, right? And there is
Mhm,
strong demand apparently in housing. And if you could get the
mhm.
right investment in the right area, I would think that would be a tremendous thing. Shockingly, retail continues to hold up. Uh, uh, I say shockingly just because a few years ago we were being told we'd never go in a store again. We were going to do everything. But retail is holding up very, very, very well. But there again, it's kind of a bifurcated thing. I mean, if you're a luxury retailer, you're doing very well, or if you're a grocery anchored or that kind of product, you're doing very, very well. But the commodity stuff that you can get anywhere is probably not doing that well. But retail surprisingly well, and this is going to surprise people too. But hotels, there's a shortage of hotels in many, many markets, and surprisingly enough, and maybe that's an area that might offset what has been data centers or life sciences or that kind of thing, where the demand, where the capital has gone in the last couple of years. Um, thought.
Let's turn to Q&A because we do have a number of questions coming in, and I don't want to lose the time for them. And I think this is a nice transition to ask this question. Somebody said they heard one of the panelists state multifamily is the favorite asset class for investment in 2026. Please expand on this, and why is it preferred over other asset classes, for example, like industrial property, which has certainly on the commercial side been the darling historically.
Yeah, that was me that made that comment. It's the safest asset out there. Like, I think that's the reason why people are going, in the last couple of years have gone. You can't make a mistake really by doing multifamily just because, it's a very granular tenant mix, obviously, just by the nature of it. So, whereas industrial is the second best market, I would imagine, from that standpoint, because it is usually are in markets it's tough to build in, and then also that you can, lease it up in a multi-tenant space. The other reason I say that is that you aren't, the reason I personally do not like office as an investment at all. I've always stayed away from it, from the debt standpoint even too, is that because you continue to rebuy your building over and over and over. As soon as a tenant leaves, you have to now replace that tenant. The tenant's down for maybe that space may be empty for 6 months. Think about an apartment. If a tenant leaves, you aren't going to let it sit there for 6 months. You can drop the rent just a little bit, and a tenant would be in there in a minute. So that's another reason why. But then you look at the office, you rebuy it, then you're down for 6 months or more. Then you find a tenant, and then you gotta put TIs and leasing commissions you pay, and you may be paying $250 a foot for that. So you continue to rebuy it. And if you really look at office buildings, if I looked at a study a while back, in the 2011 to 2020 decade, basically office only went up. It went up 9.5% during that time. 5% of that was cap rate reduction. So, the real increase, it was like 4.5. It's not a good investment. I'm an anti office player out there. So the multifamily, if you look at it on the other hand, that continues to be a need for housing always, almost in every single market across the country. And I think people look at it from a long-term standpoint or even a short-term. Like if you bought an apartment now in Washington, D.C., I think you're going to be happy because you're going to buy it at a distressed level. And 2 or 3 years from now, it's going to be strong again. Even though I think that the DC market's always been a very strong market overall. But just in general, it's just a better granular, better product out there.
Okay, thanks. A general investment question for next year. It's probably everybody's favorite. Will cap rates decrease or increase in 2026 and why?
Do you want me to start?
Sure.
I think, and I've been doing a bit of reading on this lately. They haven't decreased very much, even though interest rates have decreased somewhat. But there's always a lagging effect there with cap rates. I think at some point they will start decreasing a bit. I don't see it being significant, but there have been some sectors where cap rates have gone down a little bit. So I do think they will decrease somewhat, but I don't think it's going to be significant.
I'll take the over.
You think they go up?
I don't think they go down.
They
I
stay
mean,
about the same.
yeah, there'll be fluctuations, and I agree. You've seen a little bit of relief here or there, but just think about it. We are at a historically low spread between cap rates and the 10-year, right? Like, I mean, almost zero. That just it makes no economic sense, and it's working now for a variety of reasons, but it's not sustainable. So, absent rates going down, which I also don't, I think we're probably in a long-term for rate
Yeah.
environment plus or minus 50 bips.
I agree.
So absent that going around, I think cap rates stay roughly where they are, if not increase slightly.
Yeah, I agree. I thought they would stay. I think they stay the same. I don't think the 10-year goes below 4%, or if it does, it just drops there for a moment. I think the 10-year stays between 4 and 4.25 next year. And so I just don't see it, the cap rates compressing much more. Certain markets you may be able to get lucky, but again, it's just overall, I think it's going to stay pretty flat.
Okay. In the debt area, we talked about this a little bit about some lenders eventually having to put properties on the market. And this person wants to get I guess I'd say a bigger picture perspective on that and asks, are we moving toward another lending crisis with defaults mounting and the small and mid-sized banks' assets eroding, leaving major gaps in book value to underperforming loans? So how much of a concern is it?
I'd say based on the general outlook, that's not much of a concern related to real estate. I don't know what else all the banks are lending on that might be hiding things. Jamie Dimon might have some views on that, but it feels like we've passed the bottom, as I said, on real estate. So, there's distress to work out in the office market, but I think we already talked about that. The banks already know about it. I don't see another shoe dropping unless something weird that we haven't touched on happens.
That question might be referring to the automobile supply companies. There were two of them that have declared bankruptcy in the last few months, and that created quite a hubbub with the larger banks like a JP Morgan, but some mid-tier banks that had quite large loans to them. And so I think that's what the question is referring to. I think, yes, you're going to have some write-offs of those loans. And I think, and there was distress in those loans, but I think the banks took care of it pretty quickly. Now, will there be more of those? Possibly, yes. But they seem to have forestalled a major problem. But yes, like Richard was saying, that wasn't really real estate related. The two companies I'm thinking of that were all over the papers were auto supply companies.
Yeah, I think corporate credit is going to be the problem this time, not real estate credit.
Yep.
Richard said it best. We have reached the bottom in real estate, I think.
I agree.
And that means that the bottom has been reached with lenders in a certain degree. And a couple of years ago, we thought there were going to be all these mergers and going out of business of local regional banks, which basically are the lifeblood of real estate around the country. That's where most of the lending occurs, is from those kinds of banks. So when values were not discoverable and people didn't know how their assets were going to be used or coming out of the pandemic, there was a lot of pressure on these institutions. I think that pressure has eased, and but not to say that we're going to have a parade over this stuff. But I don't think that we're going to have the kind of disaster in this regional bank system that people at one point in time saw.
And the only counter to that is, and I agree with you, I think if we look back 3 years from now, this will be roughly the bottom. But look at Odyssey. I mean, Odyssey is still marking industrial like sub 4, right? How do you have a 4 or 4.25 interest rate and believe that your industrial portfolio is correctly marked sub 4? Like I don't understand that. So I think there's some pain to be taken in certain sectors and not just office. But broadly speaking, yes, I think we're probably in a relatively safe zone if we look back a few years from now.
Okay. Looking at another sector, there have been numerous big ownership and direction changes in the healthcare, hospital, and insurance industries. What are the ripple effects on CRE and the supporting businesses?
Well, if you own a lot of medical office, it's a mix. Sometimes your credit improves, sometimes you get a better tenant, sometimes they close a facility and that hurts. That's certainly kind of the on the ground owning medical office building perspective. And as with anything in real estate, and we've touched on this a lot already, if you own the right buildings in the right markets and the right locations in those markets that are functional and appeal to tenants, that's what you're keying on, not who the tenant is at any given time. And that's the source of the long-term value that real estate can deliver to investors. So.
Okay. We're coming up to the top of the hour. I would like to go around and ask each of you what your number one prediction is for 2026.
I'll start.
Please do. Thank you.
I kicked off this webinar saying that I had a cautious outlook, and I'll come full circle and say, I think it's going to be somewhat choppy between tariffs, interest rates, and a bifurcated job market. But I'm feeling somewhat more optimistic about with the amount of debt and equity deals out there and the dry powder out there, which I think will spur the business on.
Okay. Who's next? Ryan?
Dodgers win the 3rd World Series in a row. No, I mean, real estate related. I think data centers right now are going to be the headline for the next, foreseeable future, and everything that's sort of ancillary to that. So I think that'll be a massive focus. Unfortunately, there's only, so many ways to play in that space, at least at a large scale. So, for the typical investor, it's harder to play, in that realm. But that's where I see a lot of energy and focus. And ancillary to that, we have a massive energy crisis in this country. It's really not being advertised, but it will become a massive political issue here shortly. And I think there'll be some knock-on effects from that to deal with, if not 26, shortly thereafter.
Certainly the growth in data centers is going to feed into that. I'm just going around my screen, Jeff.
Yeah, wow. Well, I guess I would say that those who think that the United States is going down the tubes, or that the currency of the United States is not going to be the currency of the world, are missing the boat, and that betting against the United States is a bad bet, and betting against real estate, which is a huge part of, probably the most significant part of the U.S. economy in terms of all businesses and people touch it. I think if you're betting against real estate, it's a bad bet. If you're betting against the United States, it's a bad bet. And so the death has been greatly over exaggerated, I would predict.
Okay. Tom?
Yeah, mine's a little not exactly right on real estate, but generally, I think we have an AI bubble. And I think the second half of the year, I think that the top 10 companies that are carrying the whole economy and the whole stock market basically are going to have, they're going to, I don't know if it's going to be a pop on the bubble or if it's just going to be a slow deflate somewhat. But I think there's going to be definitely an impact, which ultimately, as I think through that, I think it's probably a good thing in the long run for real estate because real estate, there's a hard asset. And I think people realize that and will want to come back to that overall. I just feel like that we are so overdone in the stock market right now, where it's at. I think it's too artificially high. And I think that the AI, all these companies are, working with each other and driving up the bubble, and the stock price of everything. So I think it will deflate over time in 2026, near the end.
Okay. And Richard, take us home.
Sure. Um, Focusing on real estate here, I guess I'd just say that as we move through 2026, we're going to start to see the seeds in some markets of what happens when very limited new supply meets with a tightening market, and start to get reminded that there is potential for rent spikes. It's not going to be across all industrial or all apartments or anything like that, but I think it'll just start to point the way towards that, and I think that's going to lead to some more optimism and underwriting as we get through 2026.
Okay. Well, unfortunately, we are out of time. We will be sending everyone a link when the recording is available. And if you enjoyed today's session, we hope you'll be able to join us for our next CPE Voices webinar. And if you would like some more perspective on what the multifamily sector has in store next year, you'll want to register for our upcoming MHN Voices webinar, which is taking place in mid-December. I would like to thank all of our speakers once again for a very interesting discussion and thank everybody for joining us today.
Thank you.
Thank you. Thanks.